Hello listeners, this is Abhishek Lahoti, Assistant Vice President at ICRA Limited, and through this podcast I will be sharing ICRA's view on retail mall operators. Across the top 6 cities in India, new retail mall supply of 9 to 10 million square feet and around 6 million square feet is expected in FY24 and FY25 respectively. Though the net absorption was healthy at around 3.2 million square feet in H1 FY24, the vacancy levels rose marginally by 100 basis points to 20% as of September 23 due to new supply of 5.6 million square feet which has recently become operational and is yet to ramp up fully. ICRA expects occupancy levels to sustain at 81 to 82% as of March 24 and improve to 82 to 83% by March 25. The total Grade A retail mall supply for top 6 markets stood at 105 million square feet as on September 2023 and is expected to increase to 116 to 118 million square feet by March 25. Delhi NCR has the highest supply contribution of 30% followed by Bangalore and MMR. Delhi NCR, Pune and Hyderabad to account for 85% of new supply in FY 2025. Retail mall operators witnessed a strong rebound in FY23 in terms of footfalls and trading values, and the trends continued in H1 FY24. Backed by expected growth in footfalls, increase in spend for footfall driven by premiumization and strong urban consumption, ICRA projects the trading values to increase by 14 to 15% in FY24 and record 10 to 12% growth in FY25 on a high base. Segments like jewelry, electronics, apparels, beauty care products of premium brands and entertainment witnessed above average consumption growth in the recent quarters, which is expected to continue in near to medium term with strong consumer demand. ICRA expects the rental income for mall operators to increase by 9 to 10% year on year in FY24 and 8 to 9% in FY25, driven by healthy occupancy levels, estimated growth in trading values and rental escalations. In H1 FY24, the rental income for ICRA sample set increased by 8.4% year on year. ICRA anticipates the credit profile of mall operators to remain stable, driven by healthy NOI, backed by growth in trading values and rental escalations, moderate leverage and comfortable debt coverage metrics. The leverage ratio for the mall, measured by debt to NOI, is likely to improve to 5 to 5.2x as of March 24 from 5.5x as of March 23, with expected improvement in NOI and is likely to sustain at similar levels in FY25. Consequently, the debt service coverage ratio, which was around 1.25x in FY23, is projected to improve to 1.35 to 1.4x in FY24 and FY25, despite factoring in the increase in interest rates. Overall, ICRA's outlook on the retail mall operators is stable. Thank you for listening and stay tuned for our upcoming podcast.